Welcome to our discussion on the iShares Core U.S. Aggregate Bond ETF, or AGG for short. This ETF is one of the most popular and widely traded bond funds in the world, and for good reason. Let's take a closer look at what AGG is, how it works, and why it might be a good investment for you. First of all, it's important to understand what a bond ETF is. In general, bonds are debt instruments that are issued by governments, companies, and other organizations to raise capital. When you buy a bond, you are essentially lending money to the issuer in exchange for a set interest rate and the promise of repayment at a later date. An ETF, or exchange-traded fund, is a type of investment vehicle that tracks a basket of securities, such as stocks or bonds. The idea behind an ETF is to provide investors with a diversified, low-cost way to invest in a particular market or asset class. So, what makes AGG different from other bond ETFs? Well, for one thing, it is designed to track the performance of the Bloomberg Barclays U.S. Aggregate Bond Index, which is considered to be a benchmark for the U.S. bond market. This index includes a wide range of investment-grade bonds, including government bonds, corporate bonds, and mortgage-backed securities. One of the key advantages of AGG is its diversification. By investing in a broad range of bonds, the ETF is able to spread out its risk and provide a measure of protection against market volatility. This is especially important in the bond market, where changes in interest rates can have a significant impact on bond prices. Another advantage of AGG is its low cost. The ETF has an expense ratio of just 0.04%, which means that it charges investors a small annual fee to cover the cost of managing the fund. This is significantly lower than the average mutual fund, which can charge upwards of 1% in annual fees. So, who might be interested in investing in AGG? It's a good choice for investors who are looking for a way to add fixed income exposure to their portfolio. This might include retirees who are seeking a steady stream of income, or investors who are looking to diversify their holdings and reduce risk. One potential downside of AGG is that it may not offer the same level of income as some other bond funds. Because it is focused on investment-grade bonds, it may not have as much exposure to higher-yielding, riskier bonds. However, this is a trade-off that many investors are willing to make in order to gain the benefits of diversification and low costs. Overall, AGG is a solid choice for investors who are looking for a diversified, low-cost way to invest in the U.S. bond market. While it may not offer the highest yields, it can provide a measure of stability and income for those who are looking to add fixed income exposure to their portfolio. If you are considering adding AGG to your investment portfolio, it's always a good idea to consult with a financial advisor or do your own research to make sure it is the right fit for your financial goals.